CPP and F training group, study group. You're going to have me one more week. So we'll try to get through this as quickly as possible. I do ask that everybody put their name in chat so that we can have a brief attendance before we get started here. And of course, if you have any questions, just feel free to stop and ask away. So with that, we will get started. I am going to stop my video just because behind me can be kind of distracting. So even with my little pretend on location. So this week is international payments and health benefits. So we're going to get started on some of the international payments first. So our agenda this week will cover, for the first couple of sessions, we'll have non-resident aliens and expatriates and all of those things that are included in those two things. And you wouldn't think that they're such a big topic until you realize how many organizations or corporations really do hire your non-resident aliens and expatriates. Then we'll cover some health benefit basics, the taxation of health plans and HSA, HRA, and COBRA. And I know that we covered a lot of that already in the cafeteria plans, but this is just that next session for the taxation of it. So non-resident and resident alien taxation. Resident aliens are taxed on their worldwide income, and their employers treat them the same way they treat U.S. citizens. Wages paid to U.S. are subject to federal and state income tax withholding and employment taxes to the same extent wages are paid to your U.S. citizens. With non-resident aliens, they're taxed only on their income from U.S. sources, with some exceptions, and those exceptions are going to be important to know. Generally, foreign citizens working in the U.S. are considered non-resident aliens unless they qualify as residents. The Internal Revenue Code determination applies only to the alien status for U.S. income tax purposes and not for immigration or other federal tax purposes. Their status applies for a full year. Some days do not count when determining residency, so we'll get into how those testing statuses go. Like right here, the resident and non-resident alien test. A lawful permanent resident or a green card holder is considered a resident for income tax purposes only, because the lawful permanent resident test is based on the alien's legal right to be in the U.S. and not on the alien's physical presence in the U.S. A green card holder is treated as a U.S. resident until that status is revoked or abandoned. Substantial presence test. An alien is considered a U.S. resident for income tax purposes if the alien is present in the U.S. for at least 31 days during the current calendar year. The total number of days of U.S. presence during the current calendar year plus 1/3 of the U.S. days during the first preceding calendar year plus 1/6 of the U.S. days during the second preceding calendar year is at least 183 days with no rounding allowed. Fractions must be used. So it's very specific to know how to test for a resident or non-resident alien. Up to 60 days of presence in 2020 may be excluded due to COVID-19. So this is going to be a new feature. For the purpose of applying the substantial presence test, an alien may exclude up to 60 consecutive days spent in the United States during a time period starting on or after February 1, 2020, and on or before April 1, 2020, who, but for travel and related disruptions resulting from the global outbreak of the COVID-19 virus, would not have been in the United States long enough during 2020 to be considered a resident alien. So it's going to be those one-off situations. I'm going to give you a couple of seconds to review the examples that we have on the screen. Okay, moving right along, status. First year resident election. Some aliens who fail to meet the substantial presence or green card test can elect resident status for the year in which they arrive in the US. To be eligible for the election, they must meet certain tests regarding their length of stay in the election year and their ability to meet the substantial presence test during the next calendar year. You have your dual residency status. That's an employee may be a resident alien and a non-resident alien in the same year, a situation normally occurring in the year of arrival in and departure from the US. Employers must treat such individuals appropriately according to their status for each part of the year. Aliens who qualify as residents under the green card test are considered to be residents from the first day of the calendar year during which they qualify. Their resident status ends when they are officially no longer lawful permanent residents. Aliens who qualify as residents under the substantial presence test are generally considered to be residents from the first day through the last day they are physically present in the US. Tax treaty impact. The IRC rules for determining US residency do not supersede income tax treaties between the US and foreign countries. Therefore, if an alien employee meets one of the US residency tests and is also considered a resident of a foreign country under certain tiebreaker provisions of an income tax treaty, the alien is treated as a non-resident for US tax matters covered by the treaty. Claiming resident status. An alien can claim resident status by giving the employer a written statement stating that he or she is a resident of the US, or by completing and submitting to the employer Form W9, Request for Taxpayer Identification Number and Certification. The employer should keep such documentation on file rather than sending it to the IRS, though. If an alien does not claim resident status in writing or on Form W9, the employer may treat the employee as a non-resident alien. Taxation for resident aliens. Employers must withhold and deposit federal income, Social Security, and Medicare taxes, as well as state and local income tax, also state disability, unemployment, and what have you, where required. They must also pay the employer share of Social Security, Medicare, and FUTA. The Immigration Reform and Control Act requires completed forms W4 and I-9 are required. Resident aliens working abroad for a US employer are generally treated the same as US citizens and are entitled to the same income exclusions. Wages paid to and taxes withheld from must be deposited and reported by the employer the same as for all other employees on forms 941 and W2. The taxation for resident aliens continued. Employers must withhold and deposit. I just read that. I'm sorry. I clicked the button and it didn't go. Taxation for non-resident aliens. Non-resident aliens are subject to the same federal income tax withholding requirements as other employees for all of their income from US sources that is not effectively connected with a trade or business they are operating in the US. Immigration Reform and Control Act requires completed forms W4 and I-9 are required. They cannot claim exempt or any child or dependent tax credits and must file single regardless of their marital status. Please remember that piece. Wages paid to and taxes withheld from must be deposited and reported by the employer the same as for all other employees on forms 941 and W2. Pop quiz. When non-resident aliens complete a 2020 Form W4, they must what? B, they must check the single or married filing separately in box step 1. Again, I suggest you remember that. I know I had that question on the exam. I was surprised at how many expatriate and non-resident alien, resident alien questions I had. Calculating non-resident alien tax withholding. When using worksheet 1, percentage method tables for automated payroll systems from publication 15T, add the amount from table 1 or table 2 to the wages for the corresponding pay period. Step 2, work through the worksheet from publication 15T as you would for any other employee. Example calculations. Jorge, a non-resident alien employee, is paid wages of $300 each month in 2021. He has a 2017 Form W4 on file claiming single status, 1 withholding allowance, and non-resident alien written above the dotted line on line 6. The employer has an automated payroll system using the percentage method to calculate withholding. So step 1, because the employer has an automated system, worksheet 1, publication 15T will be used to calculate withholding. Also, table 1 will be used to determine the amount to add to Jorge's wages because his W4 is from 2017, not the new 2020 moving forward. Jorge is paid monthly, so the employer adds $687.50 to his wages solely for the purpose of calculating the amount of withholding. This additional amount is not reported on Jorge's Form W2 for 2021. Step 2, using the percentage method tables to determine the income tax withholding on $987.50, which of course is that $300 plus $687.50. Jorge's employer finds that $30 should be withheld for a single employee claiming 1 withholding allowance, whose annual adjusted wage amount is more than $3,950, but not over $13,000. I'll give you guys a moment to read through our next example. Feel free to tell me if I'm going too fast at all. We're going to skip a couple of these examples that you can read afterwards. So your NRA tax rules. The IRS regulates NRA income. Employee compensation should generally be sourced on a time basis, typically by day increments. Certain fringe benefits are the exception to the time rule. Alternate methods for sourcing income can be applied where appropriate. Residents of Canada or Mexico working in certain industries and frequently crossing the U.S. border are not subject to U.S. taxes when a written statement is provided to the employer. According to the totalization agreements, NRAs temporarily less than 5 years working in the U.S. are subject to Social Security in their country of residence only. Form 8233, exemption on withholding from compensation for independent and certain dependent personal services of a non-resident alien individual, used only to claim a treaty-based exemption from income tax and withholding by non-resident aliens, and they're completed each tax year. Tax treaties. The U.S. has entered into more than 60 income tax treaties with foreign countries that clarify each country's taxing jurisdiction to avoid double taxation of income. The benefits of tax treaties allow resident aliens to qualify for the foreign earned income and housing cost exclusions under the bona fide residence test, as well as the physical presence test. An employee's wages for personal services performed in the treaty country are partially or totally exempt from taxation by the foreign country if the employee is in the foreign country for a limited number of days and meets certain other requirements. Wages received by a U.S. teacher or professor in a treaty country are exempt from foreign taxes for temporary periods up to 2 or 3 years. The amounts received by U.S. residents for study, research, or business and technical training are generally exempt from the treaty country's income tax. To avoid double taxation, tax treaties provide for credits and deductions to reduce taxes imposed by that foreign country. Tax saving clauses provide that treaties do not affect U.S. taxation of its own citizens and residents. Therefore, most of the treaty's benefits related to a treaty country's taxes are available only to U.S. citizens who are not residents of the treaty country and U.S. resident aliens who are not citizens of that treaty country. So the impact of visa status on taxation. Again, you're going to want to know the difference between immigrant and non-immigrant visas. In most cases, if an individual is eligible to work in the U.S., then the U.S. source income is subject to income, Social Security, and Medicare taxes. Some tax treaties may exempt portions of income from taxation. Certain students, scholars, and exchange visitors holding an F, J, M, or Q visa may not be subject to Social Security and Medicare taxes when the work they perform is carried out to further the purpose for which they entered the U.S. That's going to be an important piece to know. I know that I had questions on that visa status and whether or not they would be required to pay Social Security and Medicare. Expatriates and resident aliens. Employees working for U.S. companies abroad are generally subject to federal income, Social Security, Medicare, and FUTA taxes. Withholdings may be reduced on foreign housing exclusion or tax credit of foreign tax payments. The foreign earned income housing cost exclusions do not exempt an employee or employer from Social Security or Medicare tax. For expatriates, U.S. payroll purposes, a U.S. resident or resident alien who lives and works outside the U.S. A resident alien, in the context of payroll, an individual who generally meets the green card or substantial presence test for determining resident status in the U.S. Resident aliens are generally subject to federal income, Social Security, and Medicare taxes, the same basis as U.S. citizens. To qualify for the foreign earned income or housing cost exclusion under Code 911, the employee, 1, must have foreign earned income. 2, the employee's tax home must be in a foreign country. And 3, the employee must meet either a bona fide residence or physical presence test that proves the employee is not living in the U.S. during the year in question. Pop quiz. All of the following conditions are required to qualify an expatriate for the foreign earned income or housing cost exclusion, except Great, everybody got it right? All of those apply except for being a highly compensated employee. Important terms for understanding. These are really good definitions to know. What is a foreign tax home? The location of an employee's regular or principal place of business or employment. If there is no regular or principal place of business, the employee's tax home is where the employee regularly lives. The bona fide residence test. Residence of a foreign country for an uninterrupted period that includes at least one full taxable year and where the employee considers home. Form 2555, the foreign earned income should be submitted by the employee with the personal tax return on which the foreign earned income exclusion is being claimed. The physical presence test. This test is met if the expatriate employee is physically present in a foreign country or countries for 330 full days during any consecutive 12-month period. Foreign earned income. Foreign earned income is income earned by an employee from sources within a foreign country while the employee has a foreign tax home and qualifies for the exclusion under the bona fide residence or physical presence test. Another tax tip. More important terms for understanding. You'll want to know and be able to apply the tax thresholds to these calculations. The limit on excludable amount. Qualified employees cannot exclude more than $108,700 of foreign earned income in 2020 or the excess of foreign earned income over the foreign housing cost exclusion. Foreign housing cost exclusion. Employees who have a foreign tax home and qualify under the bona fide residence or physical presence test can take an exclusion for reasonable foreign housing expenses exceeding a base housing amount. So it's the reasonable housing expense or the base housing amount, which is $17,392, which is 16% of the maximum foreign earned income exclusion. I know I had that question. Your foreign tax credit or deduction. That's another method of avoiding double taxation of foreign source income. Expatriate employees may take a credit against U.S. tax for qualifying foreign income taxes claimed by completing Form 1116, the computation of foreign tax credit, and including it with the employee's Form 1040. Example of foreign housing exclusion. Employee John qualifies for the foreign housing cost exclusion under the physical presence test for all of 2021, spending $26,500 on reasonable housing expenses in a foreign locality that was not on the list of the IRS foreign high cost localities. On January 1, 2021, the maximum foreign earned income exclusion was $108,700. John's foreign housing cost exclusion for 2021 is calculated as follows. And it looks like foreign is spelled wrong, is it? That just looks strange to me. Foreign housing cost exclusion equals reasonable housing expense minus your base housing amount. The base housing amount equals the maximum foreign earned income exclusion times 16%. So your base housing amount is $108,700 times 16%, or $17,392. Foreign housing cost exclusion is 26,500 minus that 17,392. So that amount is 9,108. For an employee to qualify for the foreign earned income or housing cost exclusion, all of the following conditions must apply except what? Great, everybody got C. The employee's immediate family is living in the foreign country. That really doesn't apply. Totalization agreements for Social Security and Medicare taxes to alleviate the burden of double Social Security taxation and to integrate coverage of employees in the U.S. government has entered into binational Social Security agreements known as totalization agreements. Expatriate employees working temporarily in the foreign country, generally up to 5 years, are subject to U.S. Social Security and Medicare taxes only. Wages earned by employees working permanently in the foreign country are subject only to the foreign country's Social Security taxes. In either case, Social Security coverage must be established with the SSA. So it's just really important to know that it is regulated by the SSA. Employer tax reimbursement policies. Most compensation and tax reimbursement policies are designed to ensure the employee will not have to pay combined taxes on income in 2 countries, exceeding the tax that would have been paid if the employee was just in the United States. So that's important to know where their thought process is coming from on all of these rules. Alternate compensation is typically provided to employees to ensure that a standard of living comparable to what they would have had if they were still living in the US, taking into account those additional taxes. Your tax protection plans, that's where the employee will be reimbursed by the employer to the extent the employee's combined income and Social Security taxes in the US and foreign country exceed the amount the employee would have paid if they'd only been living and working in the United States. Tax equalization plans, that's the idea where all patriots should continue to incur a tax burden equal to what they would incur if they were living and working in the United States, regardless of their actual foreign tax liability. Hypothetical taxes. Whether an employer uses tax protection or tax equalization to reimburse an employee for higher foreign taxes, the employer must determine the tax the employee would have paid if the employee had remained in the United States. This is known as the hypothetical or stay-at-home tax. Shadow payrolls. This is a mechanism which facilitates local tax withholding for an employee who is working abroad, but remaining on the home country payroll system and paid under a tax equalization plan. It's called a shadow payroll because the employer pays the host country taxes on behalf of the expatriate employee, and often the employee doesn't even see these calculations. Another pop quiz. In order to ensure an expatriate employee will not be overburdened by foreign taxes, an employer might offer any of the following tax plans except what? Correct. C. The foreign tax exemption. Currency conversion. The exchange rate is the rate at which one currency will be exchanged for another It's also regarded as the value of one country's currency in terms of another currency. Each time an expatriate employee is paid, the conversion occurs, requiring the use of interbanking exchange rates. I'll let you read that example. So managing our international relationships. Each organization will have their own methodology for managing relationships with third parties. One common method is through service level agreements. A service level agreement, or SLA, is a contract, whether with an internal organization or third party providing the services, identifying the expected services or performance that will be provided. Commonly, SLAs identify expectations for performance, problem management, and responsibilities of both parties. SLAs are written specifications that set out in detail the level and quality of service to be provided by one entity or service provider to another, which is the client. The entities may be different departments within the same organization, such as services the payroll department will provide to other departments, or different organizations, like a company to which payroll processing has been outsourced. Pop quiz. Foreign citizens working in the U.S. who are generally taxed by their U.S. employer on their worldwide income are considered what? Yep, resident aliens. Nice job. Resident aliens and U.S. citizens are generally taxed on their worldwide income. Non-resident aliens are only taxed on their U.S. source income. The taxation of non-immigrants depends on their resident or non-resident alien status. Expatriates' taxation depends on their status, U.S. citizen, resident alien, or non-resident alien. Health benefit basics. So now we're done. Before we go forward, does anybody have any questions on those international rules? Okay, we'll just move forward. I wouldn't worry a whole bunch about it, but I would make sure that you know the difference between those resident and non-resident aliens and what an expatriate means and those types of things. So traditional health plans, an employer either purchases an insurance policy from a third-party insurance carrier or self-insures and pays claims to employees and healthcare providers from its own funds. Self-insured plans is where the employer pays the benefits out of their own insurance funds and either administers the plan themselves or they contract with that third-party administrator to do it. Health Maintenance Organization, or HMO, provides healthcare services on a prepaid basis with employers contributing to the plan on behalf of employees. This tends to limit members using HMO and doctors only, hospitals only, those that actually participate within that HMO. A traditional plan, the HMO has its own healthcare facility or facilities, and the patients have to go there to receive medical services. Individual practice association, the physician signs up with a healthcare group and patients have the option of choosing their own physicians among those in this group. The point of service, or POS, allows covered employees and their dependents to use non-HMO healthcare providers with the inclusion of deductibles and insurance copayments. Preferred Provider Organization, or a PPO, is a healthcare delivery system giving participants a choice of higher level of benefits and lower out-of-pocket costs if they choose doctors who are part of that PPO network. State healthcare exchanges. The exchanges established by the Affordable Care Act provide the ability to obtain the economies of scale in obtaining health insurance that large organizations have had. Little test tip. You need to be able to apply the knowledge of pre-tax and post-tax employee and employer contributions to calculate net pay. Of course, we did this during the cafeteria plan weeks, but I would make sure that you practice those. So the taxation of health plans. Generally, contributions are made by an employer to an accident or health insurance plan, providing insurance for its employees, their spouses, and dependents are not wages and are not subject to federal income, Social Security, Medicare, and FUTA. Contributions made by employees from their wages for health insurance must be included in their income for income withholding and employment tax purposes, unless the contributions are made through a valid salary reduction plan. So that means it would have to be, again, under those valid Section 125 cafeteria plans. Employee choice for wages or insurance. The rules are not clear when an employer without a 125 plan, of course, that's the key, they are without a 125 plan, gives its employees a choice whether to receive a portion of their compensation as wages or to have the amount paid by the employer to a health insurance carrier to cover premiums. The IRS says that these are wages and subject to all taxes, but a federal district court stated that salary reductions are not included in income. So pay attention to any upcoming changes on that. Employer reimbursements. Reimbursements by an employer to reduce to employees for salary reduction amounts used to pay for health insurance premiums are excluded from gross income. If the premium payments were instead paid by the employees out of their salaries, any payments by the employer to reimburse the employees would be for the premium payments would be excluded. Benefits received by an employee under an accident or health insurance plan that directly or indirectly reimburses the employee for medical expenses incurred by the employee's spouse, and dependents by paying the employee the medical care provider are also not included in the employee's income. Medical expenses. So expenses incurred for medicines or drugs may be paid or reimbursed by an employer provided plan, including a health FSA or HSA. The exclusions for reimbursed medical care expenses applies only to the amount actually spent or incurred by the employee. Any reimbursements in excess of that amount are taxable income to the employee. The adult children coverage. Through the year that an employee child turns 26 years old, they are considered a dependent, and the benefit received should not be included in the employee's taxable income. So in our example, Mike's payroll service provides health care coverage to its employees, their spouses, and dependents, and an employee's child who has not attained age 27. For 2020, Mike's payroll service provided coverage to Annie and Annie's son, Russell. Russell will attain age 26 on November 15th, 2020. During 2020, Russell is not a full-time student. Russell has never worked for Mike's payroll service. Russell is not a dependent of Annie because prior to the close of 2020 taxable year, Russell had attained age 19 and was also not a student who had not attained age 24. Russell is a child of Annie with the meaning of the IRC. Accordingly, and because Russell will not attain age 27 during 2020, the health care coverage and reimbursements provided to him under the terms of Mike's payroll service plan are excludable from Annie's gross income through December 31st, 2020. Russell's coverage will continue until November 15th, 2021, but all of the coverage will be taxable to Annie from January 1, 2021. So it's important to know those insurance rules for taxation. And I think we're at a really good stopping point for today, unless somebody has request to not stop there today. I want to try to make sure that we can get through things as much as possible, and we can meet maybe at a real limited amount of time on Friday so that you all can start your holiday weekend. Anyone have any questions?
Thanks, Rebecca.
No problem. I'll see you all tomorrow.
Thank you.
Thank
You're
you.
welcome. See you. Bye.